I have yet to meet a person who enjoys paying his or her annual income taxes. Still, all of us law-abiding citizens dutifully pay our income taxes by April 15th. Fortunately, however, there are several provisions in the Internal Revenue Code that are actually tax-friendly for those who have the financial acumen and ability to save in order to take advantage of these provisions. The most common ones are individual retirement accounts, both traditional and Roth, 401ks, 403bs, and 457 plans, to name a few. These accounts have numerous tax-friendly benefits. For example, qualified plans and most IRAs are exempt from creditors of the account owner. Today, though, I would like to discuss only one of them. That is the benefit of tax deferral. Generally, when you invest your money, whether in equities or bonds, you will be required to pay taxes every year on all dividends, interest, and capital gains. This so-called drag can really slow down the growth of your portfolio because the taxes paid each year reduce the amount that would otherwise continue to grow. In a tax-deferred account, however, you do not pay taxes each year. Instead, the earnings are allowed to stay in your account, which allows your portfolio to grow much more rapidly. Let me give you an illustration of the benefits of tax deferral. Let's assume a person's marginal tax bracket is 25%, and the money is invested in a regular taxable account with a balance of $100,000. Further assume that this person makes an annual contribution of $10,000 each year for 25 years with an annual return of 5%. At the end of the 25-year term, the account will have a value of $653,728. Now, if we take the same variables but assume the money were invested in a tax-deferred account, such as an IRA, the value at the end of the 25-year term will be $815,906. That's a difference of $162,178. You can see how the benefits of tax deferral cannot be overstated. Fortunately, many hardworking people are aware of the benefit of tax deferral and take advantage of these tax-friendly IRS code sections during their working years. As a result of yearly contributions to these accounts, they are usually rewarded with a substantial retirement savings later in life. Unfortunately, though, all too often I see people fail to continue to take advantage of the benefit of tax deferral once their retirement savings accounts are left to their beneficiaries upon their death. Very few people seem to contemplate the draconian tax implications that can occur when these accounts pass to their beneficiaries without proper estate planning. For example, without proper planning, the entire account may have to be liquidated within 5 years after your death. Not only can this cause a tremendous tax hit for your beneficiaries, but they will also lose the tremendous benefit of tax deferral. Generally, the younger the beneficiary is of your retirement plan, the longer the account can continue to grow tax deferred. This can result in the growth of thousands, even hundreds of thousands of dollars of additional amounts over the period of your beneficiary's lifetime. Of course, many people are hesitant to leave an inheritance to a young beneficiary, notwithstanding the tremendous tax benefits. And they are correct to be hesitant. Most people want to make sure that the inheritance will be earmarked to improve their beneficiary's life for things such as education, health costs, and other reasonable expenses. Leaving a large inheritance outright to a young beneficiary is fraught with potential problems. The future is always uncertain, and who can be sure that the beneficiary won't waste their inheritance on gambling, girlfriends or boyfriends, extravagant vacations, and cars, to name a few. Moreover, their inheritance is at risk from potential creditors, bankruptcy, and even divorces. The U.S. Supreme Court recently ruled that unlike the owner of a retirement plan, beneficiaries of retirement plans are not protected against creditors. This means your entire retirement savings are vulnerable to being lost due to a lawsuit. This is where a knowledgeable estate planner is indispensable. Only this type of estate planner has the understanding to create a comprehensive estate plan for you that can preserve the tremendous benefit of tax deferral and at the same time ensure that your beneficiaries' inheritance will be protected from both wasteful spending and creditors. It would be a shame to see your hard-earned retirement savings that took years to accumulate lost after your death because of improper or no planning.